sheet flexibility. Justice Srikrishna committee finds Chanda Kochhar in violation of ICICI Bank's code of conduct. The former MD and CEO stands terminated. Bharti Airtel will raise $200 million from Qatar Investment Authority to pay debt in its Africa unit ahead of its IPO. We're also watching out for earnings from Bharti Airtel, Power Grid Vedanta, Hero MotoCorp and UPL today. And not to forget the fact that banks and bulls seem to be back. Banks in particular are leading the charge. Let's take a look at the trade setup for the day. Firstly, the big event that happened overnight and, well, happened technically in the US markets. One, technology stocks extended the rally after blowout numbers from Facebook, so that whole pack of stocks did very well in trade. The Asian markets cheered the dovish Fed commentary. There's a lot of to and fro about whether or not the Fed will do this or no, but I think the commentary was reasonably dovish, and that's being cheered not just by the US markets because of the results and the Fed, but also by the Asian markets, and you can see it across the screen. A very strong rally by the US markets. A follow-up or a follow-through move being seen by the Asian screen right now. So there is ammo for the bulls in today's session and maybe over the next couple of trades as well. And frankly, what the Fed has done, if you see the dot plot or otherwise, and we'll talk to some experts about this in just moments from now, but if you just take a look at the changes and what the traders expect, there are conversations about not just a pause in the year 2019, but the possibility of a cut as well. So let's wait and watch. And as I said, we'll talk about that in just moments from now. Just very quickly, to highlight our trade setup for the day, that the last 2 days we managed to close flat despite heavyweights declining. And by heavyweights, I mean the three top names: HDFC Bank, Reliance Industries. All of these three stocks over the last couple of days have been pulling back, and despite that, we've managed to end flat or marginally in the green, courtesy what's happening to a lot of other names and the sentiment thereof. And the expectations would be that the likely rally would well continue because of what's happening to the world markets. Very quickly, those stocks that you should monitor. One of the stocks which has aided the rally, at least in trade yesterday, was ICICI Bank. The post-market numbers delivery and all that happened would likely make this stock a favorite in today's session as well. Remember, a large part of a rally has happened as well, so don't look at the ADR and think that, oh, therefore the ICICI Bank stock will rise as much. But I just thought two names or two brokerages summed up the numbers very correctly. CLSA says that the visibility of earnings turnaround has risen. I think that's one key takeaway from what they've done in the quarter gone by. And Macquarie shows how people would be evaluating ICICI Bank now that it's no longer in the bearish zone but in the neutral to the bullish zone. That at the current market price, Macquarie says that the subsidiaries are virtually for free. No price for guessing that both the brokerages are bullish on ICICI Bank currently. Do watch out for that one. Hetal, and I won't talk too much about ICICI Bank or Hetal because we'll talk about them on first word, but the news: Qatar Investment Authority to invest about $200 million in the Africa unit, so keep this at the back of your mind. I thought the numbers from three names out of the many that came out were particularly weak. Ajanta Pharma, IIFL Holdings, where there's been a profit degrowth, and Hexaware, which was operationally weak. So all these three names on a good day like this, let's wait and watch what happens here. BEL, optically strong numbers, margins expanded. I tend to look at margins very, very closely these days and determine whether the numbers are good or bad. BL, the margins seemed okay, 28.3% from 17.8%. Let's see if this stock has some further ammo to itself today. Let's tell you what's lined up on first word today, though. Firstly, the big news: will the US Federal Reserve's patient stance prove to be a booster shot that the global equities were waiting for? We talked to Geoffrey Dennis and Peter Cardillo about the same. Vishwanath Nair then takes us through Justice Srikrishna's report, which found Chanda Kochhar in violation of ICICI Bank's model code of conduct. Darshan then takes us, of course, as a follow-up to the bank's improving financials as they declared the numbers yesterday. Sameet then sums up Airtel's latest fundraise and what could be in store in the third quarter. And we end with the Bloomberg Quint Cement Dealer Survey and what they had to say about prices. Nikki Mirchandani would join in on that. Let's start off with the big news, though. The US Federal Reserve kept interest rates unchanged. That was expected, but signaled that it is done with hikes, at least for now. Chairman Jerome Powell goes on to reiterate his earlier comments that the Fed is flexible in reducing its balance sheet. Kathleen Hayes of Bloomberg News reports on the fine print of the FOMC statement.
This was the meeting message heard around the world. I've seen a number of references to Christmas in January, what the markets were hoping to hear, perhaps. The Fed more concerned about the economy slowing down in rate hikes. It didn't happen on December 19th. It's definitely been made official on January 30th. The Fed making it sort of enshrining, I guess, things that it said earlier in speeches, which is that it's going to be patient now on rate hikes. Let's listen to what Jay Powell said at the presser.
We are now facing a somewhat contradictory picture of generally strong U.S. macroeconomic performance alongside growing evidence of cross-currents. At such times, common sense risk management suggests patiently awaiting greater clarity, an approach that has served policymakers well in the past.
So let's take a look at some of the things that were in the policy statement that were underscored by Jay Powell at this press conference in answer to reporters' questions. Yes, he removed that word patience in reference to future rate hikes, and in fact removed the phrase we plan on further rate hikes entirely. That's been in there for the last 3 years. It cut a phrase saying that the risks to the outlook were roughly balanced entirely. It cited global pressures, tame inflation as reasons for this patience. Now, on the balance sheet, what's going on there? Markets were so nervous about it. For the first time ever, the Fed didn't just have a monetary policy statement where all those phrases came from. It also had a balance sheet statement. Basically, it reiterated what it has said previously when it talked about the plan, but it did say that it's prepared to adjust balance sheet runoff due to economic and financial changes. Jay Powell said they're getting closer to neutral. They need to be transparent. So there does seem to be, at least the Fed's telling us, we're thinking about it.
Well, so what do these comments mean for the markets? Let's ask Geoffrey Dennis. He joins us on the show, independent EM commentator, as well as, of course, Jeff joins us from California, as well as Peter Cardillo. He's chief market economist at Spartan Capital Securities, joins us from New York. Gentlemen, both of you, thank you so much for staying up late and talking to us. Jeff, let me start off with you first. How did you read into this? While it was widely anticipated, and this was not the 3-month period wherein the Fed would have hiked rates, but the fact that they're saying that they're done with the hikes, how do you read into this statement?
I think this was a very, very supportive statement for financial markets generally, in particular, I think, for emerging markets, because this was a big change from what the Fed had said in December. It now looks, according to them anyway, that it's an even bet as to whether the next rate move is a hike or a cut indeed in rates. And also, of course, they've hinted that if necessary, they would adjust the pace of the balance sheet shrinkage, as you've just said. So I don't think you could have had a really a better statement for risky assets, including U.S. equities, but also in particular for emerging market equities. And above all, I think that almost certainly reflects some concern at the margin from the Fed about the almost inevitable slowdown you're going to have of the U.S. economy in 2019.
Peter, would you go so far out as believing that at some point of time in calendar year 19, there might be noises, if not actual action of a cut? Not that there aren't any noises of a cut, but for now, the general belief seems to be that it's an extended pause which may last for the better part of 2019.
Well, I think it's an extended pause that may last for this quarter and the next quarter. The Fed chief was very clear, expects a slowdown. Obviously, the government shutdown is going to bite into the Q1 of this year GDP growth. And so the real nitty-gritty here, and by the way, let me say that the Fed gave a good signal to the market today, very transparent, talked about balance sheets and the need to be very, very careful. And so that takes us back to one thing and one thing only. The economy certainly is showing signs of weakening. We've had several pieces of macro news that suggest weaker economic activity, but not to the point where we could be headed for recession anytime soon. Now, the point is this. The whole thing is based on the trade talks. If we get some sort of a trade agreement by March 1st, which I believe is coming. It may not be what the United States is looking for. It may not be what China is looking for, but I think there will be some sort of an agreement. And that means that the economy probably can pick up speed in the third and fourth quarters of this year. And that would avoid, obviously, negative growth. And so I think the Fed could raise one more time. Now, I don't know if you saw the news out of China. Certainly, the factory activity rebounded slightly, but still contracted. And so it's very vital for China to reach an agreement, as is for the United States. And so I'm basing it on some sort of an agreement by March 1st. And that means that stocks and emerging markets, above all, are probably going to enjoy a nice ride upward.
Interesting. Jeff, would you believe that the Fed for the time being is a no news? That what Peter was saying, that the trade truce might become the bigger news? And part two of my question is, emerging markets for the longest time of 2018 were fearing what happens if the rate hikes would be faster than anticipated. And therefore, the outflows from the EMs would be faster than anticipated. Do you think that case reverses meaningfully, Geoffrey Dennis?
Yes, I do think it reverses materially. But let me answer your first question first. No question at all. The outcome of the U.S.-China trade talks are going to be very important, and I think they're going to be very important for market sentiment, let alone the possibility, of course, as your other speaker said, that you might see a recovery in the economy in the second half of the year. So I think the pressure there is on U.S. growth as some of the fiscal dramatic fiscal easing of last year runs off. The impact of the shutdown of the economy. The U.S. economy will slow this year. The Chinese economy is obviously slowing, although this latest data was slightly better. So I think everybody generally needs to see, I think, this trade agreement. I tend to agree with the other speaker that we will get some sort of an agreement. That would be very, very good for sentiment. Whether it actually leads to a sufficient enough bounce in U.S. economic growth to push the Fed to raise rates later this year, I'm a bit more skeptical about. But at the end of the day, your second question is absolutely right. There's great fears, not great fears, the actuality of last year of the Fed getting pretty aggressive, bond yields rising, pulling money out of EM, although of course EM had a much better fourth quarter relative to other markets, other regions of the equity markets globally. The fear was obviously something similar could happen this year. I've been arguing for quite some time that was not likely. My own call is that the Fed will not raise rates at all in 2019. And even if they only raise rates once, I think, and especially if that's delayed, I think the flows are going to come out of the U.S. towards emerging markets again. And you could see this today by this very sharp drop in the dollar, which is impacting currencies across Asia, which look stronger today. And, of course, we're close to 115 against the euro as well.
Okay. Geoffrey Dennis, we'll leave it at that. Thanks so much for taking the time out and being with us. Peter Cardillo, would have loved to chat more, but out of time completely. But thank you so much, gentlemen, both of you, for staying up so late and talking to us at Bloomberg Quint India.
Thank you.
That's the word from on the Fed. And, well, let's see, divided opinion about what the Fed does in the second half. But for now, on a pause till the first half, at least, I think that's been the consensus view. Equity markets rallying on that news. Back home, a slew of news on large listed names. The Srikrishna committee has found Chanda Kochhar in violation of the ICICI Bank's code of conduct. The panel, which was formed to look into alleged wrongdoing, submitted its report on Thursday. The private lender has decided to treat her resignation as termination. Vishwanath Nair reports.
An investigation led by a retired Supreme Court Judge, Justice B.N. Srikrishna, has found material evidence against Chanda Kochhar, the former MD and CEO of ICICI Bank, in the Videocon loan case. Now, according to the report, Chanda Kochhar acted against her fiduciary duties and was in violation of the code of conduct of ICICI Bank. This was primarily because she did not recuse herself from the Videocon loan case and did not disclose to the board members that there was a conflict of interest involved in this case. Importantly, one point to understand here is that Chanda Kochhar's husband Deepak Kochhar had business dealings with Venugopal Dhoot, who is the promoter of the Videocon group, and therefore this conflict of interest was not disclosed to the ICICI Bank board or the loan approval committee, the credit committees, because of which the checks and balances that were put in place by the board of the bank were rendered useless, according to the report. The board, after reading the report, came to a decision to treat Chanda Kochhar's separation from the bank, which happened in October 2018, as a termination of her services. Alongside terminating her services from the bank, the bank's board has also decided that any unpaid dues or any unvested stock that Chanda Kochhar might have would become void, and that the bonuses that were paid out to Chanda Kochhar by ICICI Bank between April 2009 and March 2018 would be clawed back. Now, this is an important development in the case where CBI has already filed an FIR against Chanda Kochhar, Deepak Kochhar, Venugopal Dhoot, as well as some of the members of the credit committee who were on the credit committee which approved this loan. So, according to Sandeep Batra, the president of Corporate Center at ICICI Bank, the bank believes that this matter is closed as far as it is concerned. It will be cooperating with the CBI as part of the CBI investigation, and the bank believes that there is no need to initiate any kind of investigation against the bank's current officials who were part of that original credit committee which approved the Videocon loan case, because they believe that there has been no allegation or any proof of their wrongdoing in this case. But as far as Chanda Kochhar is concerned, the punitive measures by the board have already been decided.
And Chanda Kochhar has put out, of course, a strongly worded statement, not that anything else was expected, saying that she's utterly disappointed, hurt and shocked at ICICI Bank's decision to implicate her. The former MD and CEO said no credit decision was taken unilaterally at the bank, and that robust practices established at ICICI Bank ensured that all decisions were taken collectively by a committee. She went on to add that she had never shied away from taking tough decisions when required, but all aimed at the best interests of the bank. Anyways, this is a more corporate development. What will impact markets are the earnings. The profit fell in the December quarter due to higher provisions, but income rose and asset quality improved. Darshan is standing by with the key takeaways from the numbers. Darshan, good morning.
Yeah, so decent set of numbers, and last time around there was a tax write back that came in. That's why last time around the profit number was much higher. So if you optically look at it, the numbers, if you look at a flat profit growth, that's not there because last time there was a exceptional gain. But strong NII growth, 21% NII growth that came in at almost 6,900 crores. Our estimate was 6,700 crores. Provisioning was much higher, almost 4,200 crores, and the asset quality was decent. Now, if you're looking at the profit number, that was aided by the high NII that was there, and there were a lot of treasury gains, a lot of one-offs that came into the company. Strong asset quality performance. The other operational linked parameters were stable for ICICI Bank. The performance of the subsidiaries was not the best. A little bit of disappointment is something that they say. And importantly, the RBI, divergence report has not been received by the bank. So that is something that, is as of a black box at this point of time. But brokerages are happy in terms of what the numbers have come out. In fact, across the board, there have been a rise as far as target price is concerned. CLSA is saying that, the lower slippages and rise in coverage increases the visibility of an earnings turnaround, and slippages were at a 15-quarter low. Macquarie has raised the target price. They're saying at the current market price, you're getting all the subsidiaries virtually free. And Morgan Stanley is saying it's the top pick in the Asian banks at a 1.5 times FY20 core book. So overall numbers. But the other thing is that the ADR was up 9% in trade yesterday. We were also up almost 6%. So don't expect a 9% up move, at least in start is this thing that we need to watch. A 3-4% is the incremental thing that could come in, but I'm not sure that will happen or no. The bearing of the Chanda Kochhar report, I don't think it has any implication. They say that, the brokerages say that there's no direct implication because that's not affected the financials of the company. So on the core operational front, ICICI Bank has done well. But remember, it has also run up significantly post the Axis number and was one of the top gainers. So trade with caution is something that we can say.
Yeah, well, and that's well put by Darshan. Keep in mind that we had a bit of a rally ahead of the ADR rally, so that you should keep in mind. I must also add a bit of a plug out here. If you had watched Bloomberg Edge, ICICI Bank was at 365, 370 when we showed about how there could be some near-term downtake. So if you look at the last 1 month chart, you will see a bit of a pullback from 365, 370, 380 levels. all the way to those 340 odd levels, and then the pullback in the last couple of days. So keep that at the back of your mind. Darshan, thanks for putting that into perspective. That's ICICI Bank, the numbers and what brokerages have said. As I said, today's first word was about biggies. The next biggie is Airtel. It's found a new investor for its Africa business. The telecom operator is selling a little more than 4% stake to the Qatar Investment Authority. This is the second such stake sale in 3 months. Sameet Sarkar joins us with the details. Sameet, what does Airtel plan to do with the money?
Well, they'll be paying their debt in the African business. There's nothing new in that. So Bharti Airtel will be raising close to $200 million. That is close to 1,400 crore rupees from Qatar Investment Authority to pay debt in its African unit. Now, based on the earlier equity valuations that we had, QI should get close to 4% stake in this African unit. Now, that is according to our calculation. The company has not provided any details on this. Now, this fund amount, the fund infusion amount in itself is a very small amount. That is only 1,400 crore, given the kind of debt that Bharti Airtel has on its book on a consolidated basis. But this second fund infusion in itself is a very positive for Bharti Airtel, because this shows the kind of interest that investors have for the African business of Bharti Airtel. Now, this is positive for Bharti Airtel because they're also planning an IPO for this African unit, which is expected to complete by July 2019. So that is one thing positive for definitely for Bharti Airtel. Now, earlier, Bharti Airtel had sold close to 33% stake for 1.25 billion, and they had sold stake to 6 major international investors like Warburg Pincus, Temasek, Singtel, SoftBank Group, and this is the second fund infusion. And post this second fund infusion, the debt on the Bharti Airtel's African books would come down to close to $3.55 billion. Now, this fund infusion is important for Airtel as it has a debt of more than 1 lakh crore rupees in its book, and also has heavy capital expenditure plans going forward to sustain its business in the Indian market. However, this is not the first time that Airtel is selling stake in its assets outside the India wireless business. Earlier also, the operator has sold stake in its tower arm, that is Bharti Infratel, and also in its DTH business, that is Bharti Telemedia. They have earlier also they have sold stake in this non-core assets, and this is the third attempt done by Bharti Airtel to pay its debt by selling stake in non-core businesses.
Okay, so you'll watch out for this, as we will watch out for the earnings.
Yes, the earnings are expected to come in tomorrow, but so not much fireworks there. The numbers are expected to be literally flat compared to last quarter. Revenue is expected to come in around 20,451 crore rupees. EBITDA is expected at close to 6,300 crore rupees. Margins are expected to come in at 30.7%, and the company is expected to report a net loss of close to 990 crore rupees versus a net profit of close to 119 crore rupees in the last quarter. But remember, in last quarter also, the company was able to report a net profit only because of a deferred tax asset, and not because of its core operations. Core operation numbers were weak, and there was a loss in that front. So don't be surprised if the company reports a net profit in this quarter also, but because that will be only on the back of the deferred tax asset that the company has been creating. Now, the average revenue per user, that is the key number for a telecom operator, that is expected to come in 2% higher to close to 102 rupees. And now ARPU is expected to be higher because of the company's new strategy to remove the low-end subscribers. Now, in mid third quarter of financial year 2019, Airtel adopted the strategy of minimum ARPU, where it will be removing its low-end or low revenue-generating subscribers, and that is the reason why the ARPU of the company would be higher. But if you see the revenue, there is no uptick, major uptick coming in on that front. And because of this minimum ARPU plan, the company's subscriber additions is expected to be negative in this quarter. Analysts are expecting the subscriber base of Bharti Airtel at the end of third quarter to be close to 32.3 crore versus 33.2 crore at the end of the second quarter. So that's one negative for Bharti Airtel coming in. Now, for the India business, the costs are expected to be higher owing to increase in network costs because of higher data usage that we have been seeing in Bharti Airtel's network. However, the African business, that is expected to continue to do well. Now, they're expecting the African business revenue to be higher by nearly 4% compared to last quarter, while margins are expected to be flat at close to 37% compared to last quarter. Overall, on a consolidated basis, if you see the company's finance costs and depreciation are expected to be higher because of rising debt and because of higher capital expenditure plans of the company.
Okay, so thanks for putting that into perspective. So, well, a move that is the end use of which is a no-brainer. Pairing debt. Let's see how successful they are at doing that. And the last piece on First Word today is on cement. Now, construction activity picks up in January, and that's usually good news for cement makers, but that's not how it's panning out across the country. Volumes may be rising, but abundant supply means pricing power has not come back. Nikki Michandani has done a Bloomberg Quint survey amongst 12 cement dealers spread across the country to find out the on-ground situation. Nikki, good morning.
Good morning, Neeraj. Well, January typically looks like a good month for cement takers, for cement companies across the region as a whole. We've seen a small uptick coming in as much as ₹2 per bag. Well, an encouraging trend, but then meaningful recovery still remains to be seen for the sector as a whole. But then if you look at the trend that we've seen from the last 5 months, this month round we've managed to snap that trend, declining trend rather, and we've seen an uptick coming in for ₹2. Typically, the hike is coming in from the northern as well as the central region, whereas the trend remains muted for eastern and western region, while we've seen the bleakness continues for southern region as a whole. Let's look at the prices of all India cement makers for the month of Jan. You would see the uptick coming in on Jan 2019 prices, which have come up from 319 level to 321 per bag level. Let's straight up jump to central region. That's where the real hike is coming from. Central region has shown a ₹8 per bag hike. 327 goes to 335 in Jan 2019, probably the biggest hike that we've seen coming in for at least a year from Jan 18 to Jan 2019, mainly on account of the kind of push that the Holcim Group companies, Ambuja and ACC typically have been trying. Now remember that these companies are past their year end, so volume pressures definitely don't seem to be bothering them right now, and all they're focusing upon is that price hike. Now let's move on to the other region, that's the northern region, which has managed to take a price hike, but that is a price from 301 to 306 per bag, almost a ₹5 hike. But then this is coming after a rollback of ₹5 initially. Most of the cement companies tried to implement a ₹10 per kg kind of a hike coming in, but then that got rolled back and we just effectively saw a ₹5 hike. Nevertheless, an encouraging trend coming in given the muted performance that we've seen for the sector for the last 2 or 3 months. Now let's move to the lackluster trend, where you would see the prices coming in for western region as a whole. They remain flattish around that 304 level. If you look at eastern India, there also you would see a muted trend coming in, mainly on account of majority of the demand comes in from Odisha, which goes into election along with the general election, and hence you're seeing no kind of uptick in the additional order inflows, which in turn is leading to lackluster demand and in turn depressing the kind of pricing power which has remained elusive for the sector for a while now. Also, if you look at the southern region, that's the pain point and continues to be the pain point for the sector as a whole. There again, you're looking at a ₹5 cut, 315 to 310, where much of demand is coming in, or rather the volume has been dumped in from Andhra Pradesh and Tamil Nadu. However, these companies have been attempting to hold on to hold their prices to a certain level, but then again, lackluster demand ahead of general election is really weighing on the sector. The sense that I make out of this, Neeraj, after speaking to all the dealers, is the fact that there has been an uptake in Jan, but then no meaningful recovery, and they'd like to look out at these levels, especially ahead of elections, because no major demand is coming in from the infra sector as a whole.
Well, let's see how the months shape up. For now, not the best. Nikki, thanks for putting that into perspective. It's an end of first word today, though. We have packed in open. Lots of it's about earnings. We decode December quarter numbers with Prabodh Agrawal of IIFL, Srikrishna of Hexaware, Pirojshaw Sarkari of Mahindra Logistics, and Vinay Shah of LIC Housing Finance. After this break, a full tilt towards the day's trade.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
विश्व भर में लोगों से कहना चाहता हूं, कम मेक इन इंडिया। कोई ऑटो रिक्शा चलाएगा, कोई पकौड़े की दुकान करेगा, कोई चाय की दुकान करेगा। ये सब चीजें रोजी रोटी कमाने की व्यवस्था हुई है कि नहीं हुई?
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here. There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Hello and welcome. You're watching Indian Open right here on Bloomberg Quint Live. Today's session is going to be an interesting one. The global market setup looks extremely strong. Rest of Asia is trading with gains of almost 1%. And for the SGX Nifty too, it's going to be a strong day. So about 0.75% higher on the SGX, back above 10,700. So it looks like it's going to be an optimistic start at least. Let's go across to Agam Vakil now. He's joining in. Today is a very crucial day. It's the expiry of the January series, and we have got a lot of cues to pick up from there. Agam, good morning.
Good morning, Devina. Well, let me begin by talking about the rollovers, which are a tad below the previous 3-month average at around 42%. But what typically happens is a considerable pickup on expiry as far as rollovers are concerned. And coming down to the Nifty banking rollovers, again, only a notch ahead of the Nifty rollovers. Your India VIX has well come off to by as much as 3%. There has been very little change in your Nifty put call ratio, okay, so this is your open interest distribution, and well, again, very little change. We are working with a 200 odd point range based on maximum open interest in terms of changes to unwinding seen in the 10,900, 11,000 calls. Again, coming down to the Nifty put call ratio, unchanged largely. The Nifty bank put call ratio edges higher because of some gains in some of these banks. Adani Enterprises, Adani Power in the ban, and this is the case the same for Bank of India and Diwan Housing Finance. Gen Irrigation moves out of the F&O ban in terms of stocks. Equitas Holdings is one which stands out considering fresh longs coming in. Oil India sees fresh shorts. And in unwinding, there will be a bunch of counters there given it is expiry. United Breweries and ICICI Prudential stands out in trade. On the whole, it's been a very mixed day of trade yesterday, but it seems that we're likely to see some strength come through today.
All right, Agam, thanks very much for that. That's some cues coming in from the derivative space. Parthiv Shah, Director, Tracom Stockbrokers, is joining us on the show right now. Parthiv, good morning to you. Let's start off first with some numbers. And ICICI, ahead of its numbers yesterday, saw a big move of 6% odd. Numbers have not looked bad at all. Slippages are at a 15-quarter low. You've got their, gross NPA numbers at a 9-quarter low. So it looks fairly good for ICICI Bank.
Good morning, Devina. Absolutely. I think stellar set of numbers according to me, and more importantly, I think what you talked about the slippages. The slippages was no doubt very low as compared to many previous quarters. But if one were to seclude the restructured book and the watchlist book from the slippages, then I think the slippages number were even further encouraging. And the best part about the book is that I think there is no further deterioration in terms of new NPA formation, which was evident from the fact from the commentary of the management that FY19, I think as a whole will be a lot better in terms of the quality of the book as compared to this year. So I think overall great set of numbers, and operationally we never ever had a doubt in terms of this being a franchisee having almost 49% CASA. I think very good in terms of having floating rate loans wherein I think they are able to pass on the cost. And again, I think all the subsidiaries, I think they are doing reasonably well. So I think as a sum of part, I think this bank now certainly deserves a lot better valuation. And I think this is a case of point in terms of how smartly, slowly and gradually it has moved away from a higher portion of corporate book to now being at around 24%. And now the retail book has become very strong, which reinstates the fact that the ghost of the past NPAs will not again come back over next many few years. So I think overall going is very good. The NII growth was extremely strong. So even on the operational front, I think great set of numbers. So overall, I think this is a candidate for re-rating over the next 2 to 3 years.
Okay. The other bit on ICICI Bank is the Srikrishna committee, which has found Chanda Kochhar in violation of the ICICI Bank's code of conduct. Report says she did not recuse herself to avoid conflict of interest and thus failed to discharge her fiduciary duty. The findings are in sharp contrast to the position taken by the bank's board when the allegations first came to light in March 2018. For all due processes followed by the board that claimed that time. Let's put that question to corporate governance expert Hetal Dalal of IIS. She joins us on the phone line. Hetal, good having you. Thanks much for joining in. That question remains, right? How the findings of the internal inquiry be so starkly different from the external committee? What is your stance here?
Okay. So thank you for having me. A quick disclosure. ICICI Bank, through its subsidiary, is a shareholder in IIS, and the group subscribes to some of our services. To answer your question on the stark contrast, I think the first time around, the board did rely on the report provided by an external agency as well, which was subsequently withdrawn. And that is in itself, an area of concern. Justice Srikrishna's report, in terms of its scope, was to really examine the possible violation of conflict of interest policy of the bank, and I think that's where she's been found guilty. By and large, I think while one cannot deny the sharp contrast, this seems to effectively, ensure that the bank has been able to separate itself from the actions of the CEO.
Okay. Of course, she's gone out and said that she committed all her duties to the case, and I didn't expect anything different out here. But you think this is a bit of a landmark event of sorts? I don't remember the last time that there was such an enormous end to what was otherwise a fairly glittering career.
Oh, absolutely. I think for a career which has been built over so many years, the fact that, one of the few women in such leadership roles, this is indeed a sad end to, if it is the end, to a long career. I think the big lesson, though, for an instance like this is also for, corporate India in terms of just the severity of the punishment and the clawback of the remuneration. I would expect, maybe the INFS as is essentially another case where, this kind of severity of punishment could be, the management of INFS could again need to worry about something like this coming back to them as well. But I think by and large, this is indeed an example. It is not something that we see very clearly, or we've seen in the past for corporate India. And this will set a new precedent going forward.
Yeah. And hence important. Thanks for that very quick perspective, Hetal Dalal. Really appreciate you taking the time out and joining in today's session. I think there are a lot of talk on social media about how this could lead to a fall in the bank stock price. I fail to figure out how, to be honest. There could well be, and I may be wrong, but I really doubt that this will have a big implication on the stock price. In all probability, the stock price of ICICI Bank, purely led by the numbers, should rise in today's session
that
as
would
well.
ideally be the case, because now she is no longer a part of that scene. So she's, she's not a subset of what ICICI does anymore.
Precisely. You just nailed it. Yeah.
It really doesn't, it shouldn't affect the stock price of ICICI Bank purely because the numbers were so good. We'll talk about all of that and more, but our research team is ready with us. We've got a whole host of results coming out. So I'll run you through all of those. We've got our entire team ready with us. We've got UPL, we've got NMDC, and a whole host of other numbers coming out. So Nikki, Yatin, and Yash, all of them are here with us. Yash, I'll start off with you first on UPL.
Right. So Devina, the analysts are expecting a steady quarter for UPL. Revenues are seen growing by about 12.5% to 4,700 crore rupees. EBITDA is seen growing by about 16%. Margin stable around the 20% mark, while net profit that is seen improving marginally by 3.6% to 595 crore rupees. Among the key factors to watch would be the volume growth number, which analysts are expecting to be in the high single digit to probably low double-digit numbers, so anywhere between 8 to 10%, aided by the strong growth in the Latin America market, which is the key market for the company. However, domestic operations would be largely muted. Rupee depreciation, that is seen aiding the business for the company in North America, Europe, and rest of the world. However, higher tax rate and higher interest costs, that would restrict the profitability growth as well, along with the tax write-backs that the company had in the same quarter last year. That means that they're working with a high base when it comes to the net profit numbers. So watch out for these factors when it comes to UPL.
All right, Yash, thanks very much. Nikki, two stocks, Vedanta and NMDC.
Sure, I'm going to start off with Vedanta first. We're not looking at good set of numbers coming in from Vedanta. Top line, we're expecting a 8% downtick in terms of EBITDA performance. We're looking at a downtick of more than 14%. Margins are seen contracting to 26% as compared to 28%. And in terms of profitability, we're looking at a dip coming in at more than 50% this time around. Operational performance, lackluster for most of them. Aluminium, iron ore, copper. Well, the volume, the closure of copper division as a whole is expected to weigh down on the EBITDA performance of the company. Zinc India posted a 12.5% downtick. Zinc International as a whole is not expected to do well. However, we're looking at 50% uptake coming in from oil and gas division and steel division, which has started, which would contribute around in this quarter as compared to no show that we had in the corresponding quarter. Net, we're looking at lower LME prices, higher cost, and along with that, we're looking at a copper closure division, which in turn is expected to percolate down on the earnings, way down on the earnings. What we like to keep an eye out would be the outlook of the base metal prices and also the progress of the ramp of 1.25 MTPA smelter. Devina, this time around, I think NMDC would be more interesting as compared to that of Vedanta because of the kind of surge that we're looking at iron ore futures, and that is expected to percolate down in the domestic prices. So encouragingly a commentary that we like to keep an eye out coming in from the NMDC management as a whole. In terms of numbers, we're not expecting a great performance, but then look at the top line, we're looking at a 27% uptick out there. EBITDA is expected to shore up by more than 40% for this counter. Margin is at 55%. Profitability too is seen higher. Realization is seen 22.5%. What goes behind the making? Well, we're looking at a higher volume coming in this quarter and lower cost, which is expected to aid the operational performance of NMDC. Pellet prices have been on downtrend, 33% correction from the 6-year high level that we've seen in September. Essentially, as I mentioned, what we like to keep an eye out will be the pricing commentary from NMDC management. The Doni Malai issue, which is expected to be anywhere up for hearing on Feb 12 as what has been guided by the management, and stronger than expected iron ore demand, if any, foreseen by the company.
Right, Nikki, thanks a lot for that. That's Vedanta and NMDC and Hero MotoCorp, Yatin.
So, Devina, Hero MotoCorp will be not different than the auto companies which have reported the numbers. So, despite top line growth, we could see some pressures on margins. As far as revenues are concerned, we are expecting a 6% growth. This is on the back of 5% realization, growth as well as the volume growth, which will be on a similar line. EBITDA seen, down by nearly 4%. Profits seen down by nearly 5% to come in at 767 crores according to the Bloomberg poll, and we have the margins which are expected to be close to 14.4% versus a level of 15.8%. On an overall basis, do expect some pressure on margins because of higher raw material costs, but the management commentary surely would be important on the inventory levels and how are really the dealers doing as far as the ground demand is concerned, which is the retail sales. Of course, apart from that, the export markets and the outlook for demand is something important that we are watching out for in the results.
Okay, thanks a lot. We'll watch out for all of these, as we'll watch out for IIFL. The earnings took a marginal hit in the December quarter. Liquidity crisis may have compelled the NBFC to trade with caution in quarter 3, most importantly with disbursements. So what's the outlook going forward and what happened in this quarter, more importantly? Prabodh Agrawal, the Group CFO, joins us on the show to tell us about just that. Prabodh, good having you. Thanks much for joining in. So what was it? As a result of what was arguably a very tough liquidity situation, did you consciously go slow in quarter 3 or did the conditions force you to do that? And does that change in quarter 4?
Yeah, so actually we did go slow deliberately in the third quarter because our entire focus was on the liability side. We were looking to reduce our share of short-term borrowing commercial paper, which we did successfully. So the share of CP declined from 24% of our total borrowings in end September to about 12% in end December. So that's largely, done from the ALM perspective. Now, going forward in this quarter, that is fourth quarter, again the growth will come back. I would think that whatever long-term resources that we are able to raise in the fourth quarter will be used to grow our book. And of course, the focus products for us in the fourth quarter will be home loan, SME loan, gold loan, and microfinance loan. These are all small ticket loans where we are focusing, and there you're going to see some growth coming back in the fourth quarter.
Okay, if I look at the numbers, the wealth business, which for some other houses has done well, hasn't been particularly good on the profitability front, Prabodh. How do you explain what went in the quarter gone by and the outlook ahead?
So if you look at wealth business, our AUMs have grown nicely. Our AUM is up 25% YY and 11% Q-on-Q. We now have crossed 1,60,000 crores in AUM. That makes us one of the largest wealth managers in India. But what we saw was that our overall yields, the fee income, were under pressure. Partly also because IIFL is in the process of moving its customers into a new platform called IIFL One, where the fee structure is slightly different from what we were charging so far. It's a flat fee structure and the fee would be more competitive, more suitable for the customer. And that puts one-time pressure on our yields, even though we believe it will help us grow more volumes in the future. But right now, the fee income has declined by about 20 basis points. And in addition to that, the funding business also we have deliberately shrunk. So our wealth NBFC loan book has come down by about 20% Q-on-Q because, there again we are being very selective about the customers that we lend to, getting out of all non-core positions, and and because of that, even the funding income has come under pressure. So I think this is a transitionary phase that the wealth business is going through, and over time probably you will see growth coming back.
Okay, Prabodh, there is a drop in profitability in this quarter for you. Does quarter four onwards, if the situation turns to normal, do you return to growth in profits, and would FY20 also be characterized by a growth in profits?
Yeah, I would think so. The thing is that, of course, right now, all the businesses are going through a challenging times, NBFC, wealth, and capital market. And I would think that, situation would become easier in the NBFC business in FY20. Wealth and capital market also, I would think, probably right now, it's probably the most difficult period. So we still feel that there is enough potential in our wealth and capital market business to grow. So I would think FY20 should be growth, even though the growth may be less than compared to what we have seen until FY18.
Okay, Prabodh, we'll leave it at that. Many thanks for joining in today and giving us that perspective. Really appreciate your time. Parthiv, now we've had the 3 or 4 large listed brokerage stroke diversified financial services businesses coming out with their numbers. Did any of those numbers stand out for you?
We had Edelweiss, IIFL, and Motilal Oswal, as you mentioned. So basically, I think if out of the 3, I had to pick one and take that risk, I think that would be Edelweiss. This stock is, I think, really massively corrected. And I think this company also has this advantage of a 5,000 crore net worth business of ARC. And I think they have delivered and they have had past cases of resolution. So that business certainly brings a lot of value. Their structured product business in the wealth management segment is doing extremely well. They have done, I think, scaled up their NBFC business also reasonably well. And now the valuations certainly look a lot more compelling. I think they have reasonably good credibility in terms of raising funds. Recently, they had an NCD issue which got subscribed and they're well capitalized now. So I think if one has a 2 to 3 year horizon, then out of the 3, I think Edelweiss would be the company where I would like to bet on.
All right. The stock has come off sharply from levels of about 190. And in fact, the 6-month chart, as you can see, almost 50% has been given up. The stock's right now at 154. Should get in a view right now, Parthiv, from you on what is likely to happen. We've got a lot of metal earnings coming out shortly. What would you anticipate for them? They've been under pressure of late. You've been seeing prices coming off. Is it likely to show up in a big way in their Q3 numbers?
See, I think, as you rightly mentioned, I think most of the metal companies, ferrous and non-ferrous, have massively corrected from their peaks. And probably, I think a lot of negativity that one is going to envisage in this Q3 earnings, I think is already kind of factored in. Now, I think more important point, rather than seeing the volume, the realization would be how well they've mitigated their costs and how well they've saved on their spreads and the margins. So I think big companies like Vedanta, whose earnings are probably today, and I think they are the ones who have always worked very hard on a weak quarter in terms of their cost structure. So I think if they are able to deliver that, then I think the current multiples of 4 times FY20 EV EBITDA, I think is extremely cheap. And I think we know this is a cyclical industry. At times gets very, very difficult to predict the right end of the cycle. But I think overall the domestic-centric metal companies should do well over the longer horizon. Post the elections, I think Lok Sabha elections, we are expecting the trajectory of the infrastructure spend to continue. That should bode well for the metals and domestic-centric metals. And the government has been kind enough to protect this industry whenever there has been an onslaught from dumping from various countries like South Korea, China, etc. So hoping for the best, but yeah, it's a difficult time for a lot of metal companies these days.
All right, stay on with us, Parthiv. We'll come right back to you and discuss a lot more. But on to our special segment, Bloomberg Edge, where Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a particular stock. Yash, what's the stock today?
Morning, Devina. So we are tracking Astral Poly on the charts, and a buy signal coming using the fear and greed indicator, which is the proprietary Bloomberg indicator. Let's just try and understand what it is. Basically, it is the spread of 2 weighted moving averages of the true range, and it oscillates on a 0 basis line. A positive value would result in a green uptick, and that is how you interpret it, because when the fear and greed indicator turns from red to green, which is a positive value, you buy into the stock and you go short when the fear and greed indicator flips its color from green to red. In the case of Astral Poly, the value has gone up to form a positive signal. As you can see over here, the green bar that indicates a change in the momentum over here, and that is what we are seeing on the charts as well. It has been consolidating for the last several trading sessions, falling from the levels of about 1200 to as low as 1050 and below, but since then it has made a swift recovery, gaining for 3 out of the last two out of the last 3 trading sessions. And in yesterday's day of trade particularly, it jumped higher by more than 3.5% with volumes more than 3 times the 20-day average. So on the back of this, we could expect a fresh up move when it comes to Astral Poly.
How well has this worked in the past, Yash?
So Devina, 6 out of the 8 times that the indicator has turned positive, you could watch out for returns well in excess of 4% over the next 1 month.
Okay, thanks a lot for that, Yash. And for a deeper insight into Indian equities, visit BloombergQuint.com, where we identify technical triggers that have emerged in a specific stock or a sector every single day. On today's Bloomberg Edge, we feature CIAT and what its price stability band and open interest charts indicate. That's a BQ Blue exclusive. All right, Parthiv Shah is still here with us, and Parthiv, I just want to get a sense from you. Since we were on the topic of metals and mining, 2 stocks, and I believe you track them pretty closely. HEG and graphite. What's the curious case? What's happening to these stocks? They've been on a road down since the last 3 weeks. Aside from the fact that yesterday you saw them locked up on upper circuit.
See, Devin, I think what my sense is and what has really spooked the investors in this company probably is the recent development in terms of the needle coke bookings, which were done by many of the Chinese graphite companies from a global player like ConocoPhillips and Phillips 66, I think was extremely high. And I think the end product pricing has not really inched up in the recent bookings. So probably I think one is slightly fearing that of late, the key raw material ingredient, which is the needle coke prices, have run up lot faster than what the end product has. But nonetheless, I think our sense is that the domestic players, HEG Graphite, who are into ultra high electrode graphite rods, I think they are very cost efficient. And I think no doubt, I think we might have probably seen the peak of the margins, which was almost 65-70%. And going ahead at current run rate, even if they were to maintain EBITDA margin levels of 50-55, it would still be extremely high on a historical basis. Nonetheless, I think these stocks have been extremely volatile and probably not easy for a normal retail investor to digest this volatility. But I think they have really corrected heavily. And I think after this 50% correction, no doubt I would love to wait on for a quarterly update in terms of how they deliver in terms of the number and what is the outlook like. But I think from here, my sense is, unless and until I think there's a global structural change in terms of the pricing of these electrodes and demand from China, and China is certainly moving a lot of its capacities into electric arc furnace, which should bode well in terms of the volume growth. I think a lot of downside has already been witnessed and we might see some sort of relief rally. But at the best, these are now become more like positional bets. And even if one is taking an investment call, a 10%, 15% sort of a downside stop loss is must.
Right. In fact, HEG's buyback happens on the 9th of February and they report numbers around the 12th of February. So you'll probably keep a close eye out on what comes out from their quarterly numbers. Sameet Chauhan, Chief Analyst for Technical and Derivative Research at Angel Broking, is joining in right now. Sameet, a quick word on the index and what would the trade look like on this expiry day?
Yeah, morning. As far as index goes, we have struck in a range now wherein on the higher side 10,700, 720 would act as a resistance, and probably looking at the HGX Nifty, it appears that we would have a bump up right at the opening. So we would open around our major resistance. So if we look at the overall option data, also 10,700 call option for this particular series seems to have highest open interest, and from there we would see some kind of resistance. So first hour would be quite crucial. If we see some kind of unwinding happening in this strike, then we could see this rally getting extended. Otherwise 10,720 on the higher side, and lower side 10,640, 10,600 is likely to act as a very strong support. So we would keep our neutral stance, and one day ahead of the union budget also, one should say light, and a breakout on either side, probably beyond 10,750 or a breakdown below 10,580 would dictate the near-term direction. As far as individual stocks are concerned, we have two buys. First one would be Chambal Fertilizer. The chart structure looks quite encouraging. It's on the verge of a breakout, so we recommend positional target 190. Keep a stop loss around 157.5. Apart from this, metal as a space, we are contra buyers now, and we believe that it's probably toward the fag end of its corrective mode. So from here on, you could see decent moves in metal stocks. One should accumulate in a staggered manner. So Jindal Steel, which is placed around its major support, we would see some kind of relief move in Jindal Steel. Go long with a stop loss of 124.5, and we would expect a decent move towards 144.
Okay, just stay on, Sameet. Come back to you for your stock recommendations, but I think we're just about 30 seconds from market pre-open, and it looks like it's going to be a strong start. I mean, all the indicators pointing towards that. SGX Nifty is trading with good gains, almost 1% on the SGX Nifty at 10,723. You'll probably see that reflect as we open up for trade. It's going to be interesting to see how ICICI Bank in particular opens up after that big run-up that we saw in yesterday's session. Remember, Darshan highlighted that the ADRs were up 9%, but a part of that move was already captured in yesterday's trade. So you don't know whether you'll get that big bang move in today's session or no. But nonetheless, a positive move is something that you could expect. That's the Nifty pre-open. First ticks on your screen, about 0.5% for the Nifty 50. Sensex is now up about 1.25. So swiftly changing though. It's very volatile in the initial few minutes. So we'll give it some time. Let's take a look at some stocks and how they've been trading. ICICI Bank 5.7% higher this morning. So that continues its swell right up. 387 now on the counter, going from strength to strength. Now up about 3.33%. NDPC, that's up as well. Reported its numbers, 3.5% higher. Yes Bank 1.5% higher. Ultratech Cement is up 1.5%. JSW Steel at 273. Asian Paints, Bajaj Finserv, L&T 1310, so that's not bad. And then you've got the likes of a UPL ahead of numbers. The stock's up about 1%. That's just pre-open, so all these numbers could change. GAIL is up. SBI has moved up to about 0.75%. TCS, Eicher Motors, and Bajaj Finance are some of the gainers. Amongst the losers on the index, HDFC Bank for some reason is showing you a 9% tick down. Infosys is down 3.5%. You've got the likes of an RIL, Indian Oil, Hindalco. Actually should see some of the other IT names and whether the change in the H1B visas have any sort of a bearing on any of these IT names. Doesn't look like it for now. So flat for most of the IT names. M&M's down 0.1%, marginal changes. I think a handful of like 10 stocks in the red at pre-open versus the remaining 40 in the green.
The mood is certainly positive. Bring up BEL. The numbers seemed okay, and let's see if that stock is reacting positively at all to those numbers, 3.5% higher. Weak numbers include Ajanta Pharma, IIFL Holdings, and Hexaware, and let's see what those are doing in the session today. Each of them will come out. Ajanta Pharma down about 6%. Fairly wobbly quarter. IIFL Holdings, slight wobble. Management confidence showing through, but down. Hexaware, not too much. Torrent Pharma, I thought the numbers were okay. That stock looks like it'll start off on a positive note, but let's wait and watch. You never know what happens. The pre-open session is usually very, very volatile. I want to bring up Dish TV, that was very active in late trade yesterday. Z-Learn was active in late trade yesterday. And both the stocks look like starting off okay. The bond yields and the currency market, the rupee should come up on your screen as well. Ahead of the big budget, the bond yields, tomorrow that is, the bond yields, the rupee at 70.92, some bit of strength out there. The bond yield should come up on your screen as well. 7.32, so hardly any budge out there. Well, 2 or 3 names clearly stand out, and I think Ajanta Pharma is right up there. Okay. Back to our guests. And Sameet Chavan, I think you gave us one of your ideas, if I'm not wrong, which was a metal name. Okay, you've given both of your ideas. If I can press you for a name within the SL group, because they were all showing some strength yesterday, would you look to trade either a ZTV or a Dish TV or a Z-Learn?
Neeraj, I would certainly avoid, they have shown wild swings in last 3-4 days. First, a strong downtake, and which was followed by last 3 days decent recovery. So at higher levels, technically speaking, they have broken their important support. So at higher levels, you could see some kind of selling pressure. And after, especially Z Entertainment, which is the most tradable counter, it has rallied nearly, for 20-25% from its lows. So at this juncture, it would be very difficult to trade these counters. 400 to 405 seems to be a very strong resistance in case of Z, and on the lower side, 370-75 would act as a support level.
Okay. Rahul Shah, Vice President for Equity Advisory Group at Motilal Oswal Securities, is also here with us. Rahul, a quick call on the indices first, Nifty and Bank Nifty.
Hi, good morning. I think Nifty obviously will open at a higher note. So in yesterday's trade, if you interestingly look at it, I think obviously BankX outperformed Nifty, but my sense is today's session or going forward, Nifty holding about 10,690 or so. I think it can lead another 100 points on the indices. So my sense is that indices should go higher to 10,750 or 760 or also, and then it could fizzle it out, the rally.
What about your stock ideas, Rahul?
I have one long and one short idea. So stock and a long idea, obviously predominantly we saw all the corporate banks doing quite well, and that's have been focused in some time. So SBI remains a top pick in that space. So we saw good long addition in SBI and yesterday's trade. So risk to reward again could be favorable going long in SBI. So I would long SBI with a stop loss of 282 and target of 300. Short idea, I think Bharat Forge, we've seen this stock sliding from 650 onwards, and we've seen no support at the stock. So I think at the, around 480 and 500 it's been consolidating, and I think my sense is yesterday also in a markets where volatile markets, it's added a decent short position. So I would go short on Bharat Forge with a stop loss of 486 and target of 458.
All right. A Bajaj Finance, Rahul. I mean, post numbers, you saw the move on this stock. Around closer to 2,500, what would you do to the stock? with the stock rather?
See, if you look at it, entire sector has been negative, and we've seen the stocks sliding and again back to their October level, most of the NBFC stocks. So, and this stock has been resilient. So I think this is one of the outperformer in entire pack. So definitely it becomes a long for a positional trader. Obviously, the downside is limited and upside also could be limited. So, but sense is that way the markets are and way the sector has been doing it. So my view is that I would go long Bajaj Finance for another 4-5% up move from here.
Interesting. By the way, HEG and Graphite India too are starting off in the positive, about 5% apiece for both of those if the pre-open rates are to be believed. Let's wait and watch what happens there. The big mover, of course, is ICICI Bank, or should be the big mover. I haven't checked the rates in the last couple of minutes, but I'm guessing at 374, that should be packing a serious punch. Axis Bank, if it continues to rise, would be clocking in fresh life highs. Looks like it'll start off okay as well, about 1% higher. So good going here. Parthiv, the recent bias seems to suggest that there is favor for ICICI Bank and Axis Bank over the HDFC Bank and the Kotak Bank universe. If you were to put fresh money to work from a, say, a year's perspective at least, if not longer, what would you buy?
See, yes, I think we know for the fact that ICICI Bank and Axis Bank have been a consensus trade since a very long time, and the results do justify the reason for so. And I think more importantly, the commentary for next year from both the companies seems to be fantastic. So I think currently, purely based on the trail valuations, I think my bias would be more towards ICICI Bank. No doubt today we might see some sort of gap up. Despite that, my feeling is that, you know, based on the valuations and also with all the subsidiaries that ICICI has, I think there's more scope of re-rating in ICICI Bank vis-a-vis even in Axis Bank. So I think out of the two, if I have to pick one for a year's time, I think it will be ICICI Bank.
Interesting. Well, ICICI Bank and Axis Bank, as the pre-open rates are settling down, ICICI Bank at least looks like starting off okay. Yes Bank looks like starting off okay. The move though in Eicher Motors is interesting after a slam dunk for the last few days, and more important in trade yesterday, looks like starting off okay. From a trade perspective, Sameet, Chavan and Eicher Motors, would you be tempted to take a fresh trade?
Yes, but not on the long side. The stock has been, declining since last 5 to 6 months continuously. It has breached all its major support in this process. And a couple of days back, there was a breakdown seen from its recent support levels. So any bounce back, probably towards 19,500, 19,600 can be used as an selling opportunity, and we would expect this stock, heading towards say 17,000, 17,500 over the next few days.
Okay, Eicher Motors. Well, let's see. A bit of a rough day and a rough ride in trade yesterday. Doesn't look like too many stocks will have a rough ride today. IOC may start off slightly lower, IOC BPHP, and the HDFC Twins might continue to languish a little bit in trade. But let's see what happens there. Actually, that's the other key question. And, I want to ask Parthiv, of course, about his top idea too. But just before that, Rahul, 3 days on a trot now. The HDFC Twins are starting off lower. Yesterday, I think HDFC Bank broke sub the 200-day moving averages as well. Are clients taking trading positions on the short side at your dealing desks on the HDFC Twins at all?
No, nobody is taking shorting HDFC Twins as of now. But yes, we've seen other private banks where we are seeing the traders taking short positions. So we saw Kotak yesterday, a good short built up from the trading side. We also saw in IndianOpen Bank where the stock has been in languishing for some time. So I think this were the two stocks where we saw some short position getting built, while HDFC Limited and I think we saw some participation in buying at the lower levels from the investors rather than shorting it from current levels.
Okay. Stay on, German. Minutes away from market open. Let's tell our viewers all that they need to know to stay ahead in trade today. Justice Srikrishna Commission finds Chanda Kochhar in violation of ICICI Bank's code of conduct. The bank has now treated her resignation as a termination. Kochhar said in an email that she's deeply hurt by the decision, not that it's had an impact on ICICI Bank. Because
The bank also came out with their third quarter numbers yesterday, meeting street expectations, but the asset quality improvement was something that you need to take note of. It was the best in 9 quarters.
Qatar Investment Authority will invest $200 million or 1,400 crore rupees into Bharti Airtel. The funds raised will be used to pay the unit's mounting debt. The telecom major will also report its third quarter earnings later.
4 other Nifty 50 companies, Hero MotoCorp, Vedanta Power Grid and UPL will also be announcing their results today.
In key brokerage calls, CLSA retains its sell on Bajaj Auto, says the company's three-wheeler and exports growth is likely to taper, cuts price target to 2,225 rupees from 2,450 rupees per share.
And Castrol's board approves proposal for capacity expansion of its Gujarat facility from 100 million litres to 140 million litres with an investment of 138 crore rupees. All right, that's all that you need to know. We have about 3 minutes left to go from market opening. Parthiv, just want to get a sense from you. While we've spoken a whole lot about individual stocks and the earnings performances, anything in particular that has caught your eye that you would like to mention?
Yes, I think, and even a kind of a stock idea too. I think Castrol. This has been a dead stock since so many years, and I think despite being the blue chip, it is for the fact it has around 150 crores of fixed assets, and in terms of the return ratios, I think unimaginable. I think ROEs of almost 80% in so many years, ROCs of above 100% in so many years, and now I think the best thing is that they are upbeat in terms of the market scenario. After such a long time, they're talking about the capex, and that capex is by no means small, though the number in terms of the balance sheet strength of Castrol might look less, but almost a 40 to 50% sort of a capacity enhancement goes to show that I think they are upbeat. No doubt, I think it had its lapses in terms of the competition taking over a lot of market share, but now it seems that Castrol is upping its game, and these quarter numbers I think were really encouraging in terms of not only the margins being maintained but the volume growth and all parameters. And frankly speaking, there's a lot of talk about this EV taking over, but I think a lot of that negative seems to be getting priced into Castrol, and Castrol is available at trail P multiple of 22, and if I were to look into the capacity enhancement over the next 2 years, then I think it's quoting at 15-16 times, which according to me, for a quality franchisee like Castrol having extremely high dividend yield after the low price, I think looks extremely compelling. So it can be a nice safe portfolio parking sort of a stock, and if one has a 2 to 3 year horizon, I think this can really surprise in terms of the upside.
Right, got it. Parthiv, we leave it at that. Thank you so very much for joining in. Castrol is Parthiv's bet right now. KEC International's stock reported numbers yesterday did well in yesterday's session. Pre-open tick showing a 3% move on the stock. Quick call, Rahul, on KEC International.
I think mid caps, I think, still are resilient to participate in the markets. So my view is, I think I would still avoid a mid cap stock, and I would continue still on the large cap or
All right, so even from a trading point of view, still sticking with large caps. 1 minute away from market opening, so let's get in some top trading calls from our technical experts. Sameet, why don't you go first?
I'll go with Chambal Fertilizers. Despite individual stocks having a massive correction of late, this stock has managed to show some kind of strength, and in last couple of days we have already seen good buying interest. So Chambal Fertilizer looks to be strong bet. Positional target would be around 190, keep a stop loss around 157.5.
Rahul, your top call?
Top call, obviously, I would go short on Kotak Bank from current levels. I feel that there's some downside in the stock, and as we spoke earlier also. So I will go short in a Kotak with a stop loss of 12.38 and target of 11.90.
Okay, Rahul, we'll leave it at that. Thank you so much for taking the time out and being with us and giving us that perspective. We'll watch out for the Nifty Bank too. Frankly, it's a case of banks leading or helping the index the last few days. And we will take in one strategy from Sameet Chavan post open on the Nifty Bank, because that's really the key driver for the markets the last 3 sessions. Yesterday, it was the big support for the Sensex and the Nifty as well, what the banks did, and today expiry day could be interesting. But here's how we're starting off. Good start to the trading day, and not that anything else was expected. The Nifty Bank leading the charge yet again, actually at par with what the others are doing. The mid caps and the small caps too would have started off well. So just a cursory glance, yes, doing okay. Let's get the heat map up on the screen. and show you what's moving and what's not. ICICI Bank, the big boy, up about 1.5%. SBI about 1.5%. Any other banks in the top 10? No, those are the only two. But then a clutch of other names have come to the fore today. Reliance Industries in the green. There is strength in Larsen & Toubro, so that is doing okay. And metals seem to be doing rather okay for themselves. So JSW Steel, Tata Steel, Vedanta, that entire clutch of names is doing reasonably well for itself in the session today, but only two banks in the top gainers list. What's not doing well? OMCs on expected lines, otherwise not too much. So it's essentially banks and metals which are starting off well, but not all the banks. Quite unlike the last few days, not all the banks, and SBI is not, rather ICICI Bank is no longer the top gainer. It's the third best performer, so it's quickly slipping as well after the rally that we already seen in trade yesterday. Okay, so that's the index for you. A lot of green, very little red. Not surprising. The indices slightly off the highs, opening highs for the morning, but early days as yet. Just a couple of trends that I want to point before I hand it over to Devina. Firstly, weak quarter for each of these names, and they are starting off accordingly. IIFL in particular, 4.5% lower. Profit degrowth. Not that the other brokerages have done something quite different, but this was a weak quarter for them, and it's starting off weak accordingly. Hexaware, we'll hear the management at 9:30. That stock is down about 1.5%. The stocks that remain in focus include the Z Group stocks. So all of them start off marginally positive in the session today. Z Media in particular up about 4.5%. Devina, what are you spotting?
LIC Housing Finance also reported its quarter 3 numbers. Standalone numbers, you had profits rising about 25%. Stocks up about 2.5%. Dixon Technologies consolidated numbers. Profits came in higher by about 16%. Margins expanded to 4.9%. The stock is up 1.2%. Aside from that, DB Realty in the broader market space is doing okay, about 5% higher. Dredging Corporation at 417, that's up about 4%. EIH, that's up about 3.5% at 187. The likes of a Natco Pharma. Natco Pharma is at about 700 now, so that's a 3% move up. Jubilant Foodworks, yesterday's session saw a flattish move, had reported its numbers. Same-store sales growth of about 14%. The stock today has moved up. Vinati Organics also posted its numbers. Stock's up about 2.7% right now. VIP Industries, that's up about 2.5%. And the likes of Bharat Electricals is up as well. Amongst the losers, Diwan Housing continues to reel under pressure. 4% under for Diwan Housing Finance. Ajanta Pharma, already highlighted by Neeraj, is down. Mahindra Holidays is down 2.6%. Jindal Stainless, a smaller name, down 2%. Kolte Patil from the real estate pocket is down about 2% as well. That's what you've got in terms of the broader market performance. Still, the trend remains positive. The advance decline ratio is stronger this morning, almost 1:4 in favor of the advances. 839 stocks advancing, 277 stocks in the red.
Well, just quick opening thoughts from Sameet Chavan. Sameet, the bank nifty, it's essentially the key leg, I reckon, for the markets the last few days. About 129 points higher today. What would you do if you were if you had an existing long position, or if you want to create a fresh one?
Neeraj, if you would have asked me a couple of days back around 26,500, which was the 200-day moving average for Bank Nifty, and it was the previous breakout point as well, then probably we would have given some contra buy call for at least a 400 and 500 points up move. So that up move has already come, and just ahead of the event around the important resistance of 27,000, 27,100. I don't want to get into Bank Nifty at this level. Rather, if I have existing long position, I would either trail my stop losses or I would rather book out my profits somewhere around 27,000, 27,100. So once Bank Nifty surpasses 27,100, yes, we could see an extended move toward 27,500 or 27,700 as well.
Right. Sameet, we leave it at that. Thank you so very much for joining us this morning with your views. That's Sameet Chauhan there. Joining us now, we've got Pramod Gubbi, founder at Marcellus Investment Managers. He's joining us on the show right now. Pramod, good morning to you. And, I'm going to start off straight off with tomorrow, because it's nonetheless an important day. We're going to be watching out closely for what comes out from the interim budget. But what is it that you have factored in? And from a market standpoint, do you expect anything meaningful?
Not really. I think given it's a vote on account and not really a full-fledged budget, I don't think one should read too much into it. In any case, irrespective of what's announced, I guess once the elections are over, you'll have the new government coming in and putting their thoughts through. But having said that, I think it'll be an indication in terms of what sort of populist measures, typically in an election year, that's the sort of thinking you'll see from any government. Doesn't matter which party is in power. Now, how does that translate into the fiscal deficit is what the market will be watching. We're clearly seeing strains on the fiscal deficit. That's putting pressure on yields as well, and that has an effect on the overall markets through crowding out. And that's something which everybody will be watching out if the government goes the whole hog in terms of pushing through welfare schemes with no commensurate measures to increase the revenue side of things. That'll have a bearing on cost of capital and asset prices across the country. So that's pretty much what we'll be watching out for tomorrow.
All right, just taking a look at how we are positioned in the market at the start of this new year, it's going to be a volatile ride ahead nonetheless. And, most international brokerage houses have not been too gung-ho in terms of target prices that they've put out for the index, 11,200 at max. What would your earnings performance and your targets for the index look like by the end of this year?
I think the index remains a pretty average performer because you have a mix of all sorts of companies, right? So there'll be some winners, some losers. So from our perspective, where we run more of a bottom-up strategy, the index performance is a bit irrelevant. To that extent, we don't really care much about where the index is going or the index earnings is going. In fact, if you look at bulk of the index companies haven't really delivered. Forget about earnings growth, the return on capital has been below cost of capital for long periods of time. So there's no real investment case for majority of the index companies. To that extent, we tend to ignore that, at least from our own portfolio perspective. But having said that, I think the events of last evening in the US or a few hours ago will be the center of attention for the year going ahead, because until now the assumption was we are looking at cost of capital rising steadily, given what the central banks are doing. Not so much about the rate hikes or the pauses, but the balance sheet action, which was clearly in terms of a retreat mode, or QT, if you can call it. Given that assumption, cost of capital was set to rise over the next couple of years at least, until we had a catastrophic scenario in the economic growth and the markets. Looks like the Fed has taken heed of the situation already, given there are various pressures on the economic growth, global trade being one of them. And if the unwind of that tightening happens earlier than expected, it could change a lot of equations. Having said that, these are early days. This is just the one meet. We have seen a change in wording from the Fed as well, particularly on the balance sheet, that they're not likely to tighten, or at least they're open to adjust the balance sheet unwind. If that happens, I guess, then perhaps it's better days for the market, better days for most asset prices. But like I said, it's early days. We'll have to watch. The Fed is watching the economic movement as well. And the inflation scenario hasn't really, perked up as much as they would have thought. Given both this, I think one should watch out for liquidity conditions in the global markets going forward.
Okay. How does so? Let's assume that the backdrop is that the liquidity situation doesn't turn adverse because the Fed doesn't hike, maybe even cuts rates going ahead into the second half or otherwise. What's the earnings leg looking like for India to do well? Because banks seem to have come back. The others maybe not. Consumption, particularly companies like Maruti and their commentary, doesn't inspire too much of confidence. So there's a bit of a tug of war between the ones which were performing and the ones which could start to perform.
Yeah, I think consumption has had a great run over the last 2.5 years, right? So across automobiles, discretionary, even some of the staples companies have reported healthy volume growth. At some stage, this was supposed to cool off anyways. I wouldn't read too much into it because more from a longevity perspective, right? Given our demographics, given the size of the country, consumption perhaps will never go out of favor. You might have a few quarters where you'll have high single digits volume growth at best. It won't turn negative, but get back into early teens sort of a volume growth is what is the sustainable scenario we should expect. We need a little bit of push from the government as well, particularly in rural exposed consumer goods, which has had a tough time in the recent past. I think at some stage, irrespective of which government comes into power, we'll have to look into that, and any sort of measures should help revive consumer demand, particularly in the rural economy. On the discretionary and urban consumer sides, I think it's slightly more cyclical than staples. We've had a great run, a little bit of cooling off, and perhaps on the other side of elections, with a few measures from the government, we should see pick up in demand generally. But the best part is, I think the sort of companies in these sectors are pretty strong in terms of competitive advantages in brand and distribution. They should come back quite strongly. So I wouldn't worry too much about consumption in India going out of favor as a theme.
So I remember you guys were amongst the earlier ones where recommending a buy on the CV cycle, right? Are you guys a buyer into Ashok Leyland, Maruti and Eicher, as all of those premium stocks have fallen 33% at least, in Ashok Leyland's case, half from the recent highs?
No, not really. I think some of the demand has been preempted through various regulatory changes that are brought by the government, and as a result, you will have a cool-off period. I think what we need now is a proper industrial recovery, particularly for the commercial vehicle demand. Commercial vehicle sales in the last 2 years have preempted that recovery. In anticipation of that recovery, you've had a lot of sales. In anticipation of regulatory changes, you've had sales. So there's a little bit of catch-up to be done on the demand side of things. I mean, if liquidity conditions globally remain benign, and if the government gets its act together on the other side of elections in terms of more favorable policies to pick up the investment cycle, I think that's when you will start looking at some of the commercial vehicle players, which are closely linked to industrial demand. Passenger cars, on the other hand, is a slightly different situation. I think the big trend you need to watch out for there is the competitive scenario. I think demand will come back. It's not like passenger cars penetration in India is quite high. It's, there's plenty of runway for that as far as the growth runway is concerned. But competitive scenario could change with several new entrants coming in, new models coming in against the market leader, which is pretty much the only play in the sector. So if you were to play passenger cars through the market leader, you better watch out for what competition is doing.
One particular pocket that has, kept pace has been the technology space, and this time around it's not just because of what the currency is doing. Their operational performances, their organic growth numbers have been encouraging, and not just the top tier companies. You're looking at decent earnings from the mid tier companies as well. Is that going to be a theme that you will pursue?
Absolutely. We have been for quite some time now. It's been one of our top picks in terms of sectors. It has done well over the last 2 years. Valuations aren't as cheap as they used to be. But having said that, like you said, besides the currency push, some of the investments that the top IT services companies in India have made are beginning to bear fruit now through order inflow in some of the new areas. We talked about cloud computing, analytics, which had become a bane for this sector, is actually becoming some sort of a tailwind because the investments are beginning to play out. Having said that, again, linking back to the Fed situation, if we see a dramatic pullback by the Fed in terms of its liquidity stance, you might see the dollar retreating, and in that case, that might be a little bit of a headwind for IT services.
We've already seen that today. We saw one move already coming in.
Correct. I mean, like I said, it's just the one announcement.
Yeah.
If you see this as a trend, then you might see the rupee strengthen again, which may not be particularly great for IT services companies. But early days, we've just had one announcement. There's several moving parts in the global economy. Fed will be cognizant of that. It doesn't necessarily mean that they'll start printing money again. We're far from that. We might see some sort of a sideways movement in terms of interest rates as well as balance sheet contraction, in which case you may not get the tailwind for the rupee anymore. But this is one space, if you're an investor in Indian IT, you would want to look out for.
All right. Just one theme that I want to ask you about, in terms of looking at investments. One, would you look at earnings stability versus the kind of earnings that are coming out? I mean, for companies that are stable in giving earnings performances, would that be something that is an attraction to you versus just the number? And second, would you also look at companies that are high on return on capital employed versus just giving earnings performances? Because that indicates that the earning capability is there, and what the company can do for investors and shareholders is a lot more.
Absolutely. I think return on capital employed over cost of capital, that gap, that delta is key in a country like India where growth is pretty much a given, right? It's not like you'll have to really hunt for growth. If you're not disciplined enough to generate the high return on capital, then any amount of growth can be value destructive in nature. So for us, return on capital employed over cost of capital is paramount. Having said that, again, I think the earnings predictability is also a key element because we tend to take long-term positions. In long-term positions, the longevity of this growth is far more critical. And to predict earnings over a long term, this high return on capital is important because that excess return on capital over cost of capital is what funds your future earnings growth as well. So high return on capital and sustainability of earnings is what we look out for.
Great having you today, Pramod. Thanks so much for taking the time out and being with us. Hopefully the budget turns out to be a non-event for the markets, as it should be, actually. Take a very quick break on the note that the markets are doing okay. On the other side of the break, we decode the December quarter numbers of Hexaware Technologies, Mahindra Logistics, as well as LIC Housing Finance.
City Union Bank, trust and excellence since 1904. City Union Bank, trust and excellence since 1904.
$18,500 गांवों में 1000 दिन के अंदर बिजली पहुंचे, ये काम पूरा करके दिया जाए।
केंद्र में मोदी सरकार और राज्य में देवेंद्र सरकार आई, में हजारों लोगों ने आत्महत्या की है और दूध का जो रेट पहले मिलता था पुरानी सरकार में उससे भी कम हो गया है।
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out there.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that will sustain.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We're getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
Hello and welcome. This is the earnings special on Bloomberg Quint. I am taking stock of Hexaware Technologies quarter gone by, that is the fourth quarter of 2018. Well, it's been a quarter in which has been largely in line with consensus expectations. And to take stock of what's gone down and what we can expect for the many months in this year to come, I'm in conversation with the CEO of the company, R. Srikrishna. Mr. Srikrishna, good morning and thank you so much for joining us. Let me begin by asking you about the guidance that you have given for 2019. What are the factors that you are taking into account and what are the possible challenges that you may face given given the guidance that you have set for as far as this coming year is concerned?
So we expect to get back to delivering industry-leading organic growth. That's the simple substance behind the guidance. We put out 12 to 14%. We've been doing that for many years. If you look at last 4 or 5 years' performance on organic growth, I think we've simply done the best. Last year was we did well, but not as well as we usually do. But there was some well-documented reasons that we had some client issues overhang from FY17. That's truly behind us now. And so we expect to get back to delivering industry-leading organic growth. What's behind that? Just broadly 2 sets of factors. We had a robust year in terms of booking new deals from new clients. We had actually our best quarter ever in Q4 in terms of new deal bookings. We had our first ever $100 million client. And so that's one factor. And additionally, and perhaps more importantly, we're very confident in mining our clients, both from the perspective of expanding demand from those clients, but also gaining market share in each of the important clients we are in. So it's a combination of both solidity in existing client base plus solid new deal wins that give us confidence in FY19 growth.
Sure. So in that case, Mr. Srikrishna, if you could tell me about the deal wins over the past couple of quarters, perhaps a little more about how this previous quarter has gone by and what that can do for the upcoming 2 quarters with respect to growth, perhaps something to do with the operating profitability as well.
Sure. So, let me start with Q4, right? So Q4, we had about $115 million of new deal wins. Of that, actually, there is a single deal of about $100 million. Now, that deal is going to be growth accretive for FY19, but not hugely so. So we're going to see revenues from that deal only from September. And actually, a vast majority of the ramp-up will actually happen through 2020 because it's complex, it's Europe, lots of labor issues for us to get through before we start execution. It's also from Nordics. It's an important new market for us, something that we've been working hard on over the last 3 years. So this now represents our 3rd big client, or actually 4th big client in the Nordics area. There are other deals which are very cool. So we have a client for whom we're building a cloud-native application that will give information about ports worldwide, any kind of information for any ship that wants to dock in any port. We'll be able to provide through this application, cloud-native application, information that ships may need. And finally, we have a large commodities exchange in the US for which we are doing a large DevOps program. So those are the 3 kind of new deals that happened during the quarter 4. The latter 2 deals, which are smaller, will actually be revenue accretive, essentially from Q1, and it'll step up in Q2. But the biggest deal will actually get yield revenues from Q4, a little bit in Q3, but mainly from Q4.
Okay, so from what I understand, the guidance that you provided for is 12 to 14% in terms of organic growth. In that case, what kind of acquisitions would you be looking for, if you have anything in mind at this point in time based on the deals that you already have? If you can tell us a little more about your inorganic strategy.
Sure. Like you said, that the guidance is all for organic. So if and when we do an acquisition, it is going to materially increase our growth rates. Our desire is to spend $250 to $300 million of capital in the next 3 years. And of course, it is subject to finding the right target at the right price. And if you do that, then we think it will add 5-6% of growth each year over the next few years on top of our robust organic growth. So where is the money going? We have 3 elements of our strategy. Everything we do is aligned to 3 things: automate everything, cloudify everything, and transform customer experiences. So our first dollars in acquisition will go to transform customer experiences. Our second dollars may go to cloudify, but our current focus is on investing in the automate everything area.
Okay. Also,
I'm sorry, in the transform customer experiences area.
Sure. Okay. So the other aspect that I wanted to address was the fact that the industry itself is looking at a little bit of a talent crunch, because of which your people costs have gone up. And my question really is that how has this panned out for you? Secondly, when it comes to talent and industry, if there is a crunch when it comes to supply, in your experience, how long do these phases in cycles last, and what could be the implications on margins going forward?
Sure. So, we don't expect the U.S. tightness in labor to go away anytime soon. So our strategy for solving it is not contingent upon the market conditions changing. Our strategy is essentially, at least in part, working around the fact that there will be a tightness. So our three-pronged strategy is this. The first is what everybody is doing, which is to pay more. And that's one of the reasons why you saw our margins go down Q4 to Q3 to Q4. It's our wage increment cycle, but we had higher wage increments than usual. The second strategy is that we are investing to create skills in the US. So while it is hard to hire laterally, I think there is an opportunity to hire fresh young grads and train them in the US, and which is what we're doing. Our third strategy is to actually create a labor pool in Mexico. So we have actually a large center in Mexico from where we deliver services, but additionally it's also a source of talent into the US, much like H-1B is a source of talent. There's a separate visa category in Mexico called TN visa. So we are investing in skill creation programs in Mexico at all levels, at college grads, but also mid to senior levels, and creating talent there which we can then bring into US. So that's our three-pronged strategy. We don't expect us to be able to solve all of it overnight. We called out the problem first in Q3. We said it'll take us some quarters to solve it, but we are solving it incrementally. So we are well on our way to solving it. I mean, some of it got solved in Q4. You're already seeing better revenue performance. We'll continue to solve Q1 and Q2, and I think by Q2 we will have a lot of those three elements of strategy fully executed.
Okay, so my final question then, Mr. Srikrishna, is if you leave aside this up move in your people's costs, what are the other factors that have worked against margins in this quarter perhaps? If you could tell us a little more about how currency has panned out, and if there are other variables that are also in play that may have worked for or against margins in this particular quarter, and how these variables could pan out moving into the next few quarters.
Sure. So our Q3 to Q4 every year margins come down. So for us, it is a very well-established cycle. It does actually for many companies too. There are two big sets of reasons. One is furloughs and the fact that the calendar is also lower in Q4. And so we lost 60 bips on furloughs and calendar this quarter. That'll come back. So furloughs don't happen. Calendar is still weak in Q1, but it'll come back strongly from Q2 onwards. The second factor is wage increments. So it is not an out-of-cycle wage increment for us. Q4 is our usual wage increment cycle. So we have a little bit in Q3 in August and September, but the vast majority of employees globally, both onshore and offshore, the increment cycle is effective October 1st. So that's the second big aspect, and of course that wage increment cycle will come back through the year. And the wage increment contributed another 60 bips dilution. So what we've said is this, that we expect at a minimum for our FY19 to be at the full year margins of FY18, which means from the Q4 levels there will be a substantial step up. And it will happen maybe a little bit in Q1, but mainly from Q2 onwards.
Okay, Mr. Srikrishna, we'll leave it at that. Thank you so much for joining us and taking us through the quarter gone by, as well as the outlook for the company. Thank you.
Thank you so much.
हकीकत में ये गुड एंड सिंपल टैक्स है। The 500 rupee and 1000 rupee currency notes will no longer be legal tender from midnight onwards.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Mahindra Logistics posted a strong 18% rise in its revenue, but its EBITDA growth has come down a bit and margins have remained flat. Now, to help us decode the factors at play in the quarter gone by, joining us now is the CEO Pirojshaw Sarkari of Mahindra Logistics. Sir, your revenue growth was higher in the third quarter compared to the last quarter. So what aided that kind of growth in this quarter?
So we have grown our revenues by more than 18% in the third quarter, and even our non-M&M SCM business has grown by more than 15%. As you know, the third quarter we have won a lot of new customers, and we have started implementing those businesses in this quarter. These will continue as implementation takes a couple of months, and this will continue into the fourth quarter itself. Having said that, in the third quarter this year, we also had the Diwali peak. So e-commerce as well as certain consumer companies have their sales, and therefore business has increased in the third quarter.
However, the EBITDA growth has come down a bit for the company. In fact, the margins have also remained flat compared to last quarter. So what can one expect going forward on the margin front?
On the margin front, as I have said, year to date, we are looking at an expansion of 50 basis points, and I continue committing on that. During the peak seasons, as volumes grow up substantially, the margins take a little beating, but this will get neutralized in the next quarter.
But retail fuel prices were down drastically in the third quarter. That should have aided your margins, right, in the third quarter?
No, so basically, one of the things you must understand is the automotive industry has gone through some kind of downturn. And when you do in-factory logistics in a big way for the automotive industries, their production NPD days, which is non-production days, have increased in this quarter. But we see that normalized as we move ahead, and in the next quarter, these should come back.
So then what could be the margin range that one can expect from Mahindra Logistics going forward?
So as you can see, our year-to-date margins, especially our PAT, has increased by 41%. Our focus as an organization has been on increasing our margins. Margin expansion takes place if we add on more warehousing and value-added services. And in this quarter itself, our warehousing and value-added services have increased by 33%. And this effect will come in through the next quarters as we are implementing these businesses now.
But sir, can you give me a margin range for the coming year?
So our margin ranges, I have always said that transportation has a low margin range, anywhere between 6 to 10%. Warehousing margins can go from 12 to 18%, and that's what we have maintained throughout.
There has also been a slowdown in the auto sales volume that we have been seeing. So how has the company been impacted because of this?
So our non-Mahindra business today has 26% of the business as automotive and 74% as non-automotive. And this diversification really helps us at the cyclical times of each of the industries. And we have seen that during this quarter, in spite of the auto business going down, we have still been able to grow our business by over 18% only because of the diversification that we have in other industries which have grown, like the consumer, the e-commerce and the bulk.
So you're confident about the growth rate going forward?
We are confident about this growth rate not only from other industries, but we see that the automotive industry will also come back.
And how was the non-M&M revenue growth in third quarter?
So both Mahindra and non-Mahindra grew well in the third quarter. The non-Mahindra grew by 15.5%. The Mahindra business has grown by over 18%. Both of these have attributed to the growth of our business in the third quarter.
And how do you expect to ramp up this segment of the business?
Our focus has been and will continue to be growing the non-Mahindra business more exponentially. We have set targets for ourselves to be a 50-50% company very soon, and we are on our path to achieve that.
Lastly, on the PTS business, now growth was steady in this counter. Well, the margins also saw a good expansion. So what is your outlook, and how do you plan to expand this business going forward?
In fact, this quarter has been one of the best quarters for our PTS business. They have clocked 100 crores of revenue in the quarter, which is the highest quarterly revenue that PTS has ever done. They have also expanded their margins by more than 100 basis points. And therefore, we are looking at this business very closely. More and more, the industry over here is looking at security for their staff. As you know, more than 33% of the employees that we move are lady employees who work at night. And for them, security is the topmost quality that they see in Mahindras.
Well, that would be all, sir. Thank you. Thank you for speaking to Bloomberg Quint.
Anything and everything about your investments. We're just a touch away. Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Hello and welcome to Bloomberg Quint. LIC Housing Finance has reported operationally healthy numbers this quarter. Disbursements and outstanding loan traction was healthy. However, asset quality witnessed a deterioration led by individual books. Joining us, we have Vinay Shah, MD and CEO of LIC Housing Finance. So, sir, will you take us through the key numbers like disbursements and outstanding loans reported by your company this quarter?
Yeah, we disbursed about 12,778 crores as against 12,292 crores during the same period last year. The portfolio grew to 1,81,698 crores as against 1,56,176 crores, showing a growth rate of about 16.34%.
How has been the company's asset quality for this quarter?
The GNPA increased from about 1.20% to 1.26%.
And so if you can give us more details.
The net NPA increased from about 0.81% to 0.93%. The contribution to the total GNPA was mostly from the home individual segment.
Okay, the NBFC crisis plagued its markets this quarter. So how has your company been affected this time?
The NBFC crisis had a direct effect mainly on the liquidity position in the market, but we were not much affected by the liquidity position because money was available to us. LIC Housing Finance being a AAA rated company, availability of money was not a problem, but yes, we did have higher borrowing rates to be met, and that was the only thing which affected. Our cost of borrowing went up by about 15 basis points in Q3 because of that. Other than that, there was no issue relating to liquidity that affected us.
Okay, what is your margin profile going into the next quarter?
Currently, we are having NIMs of 2.33%. Going ahead, I would see some improvement in it in Q4.
So can you give us a ballpark figure?
I would not hazard a guess arriving at some figure, but traditionally our NIMs have been in the range of 2.3 to 2.7 in that range. So probably we will target at improvement on these 2.33% levels.
Okay, sir, what is your view on the pain being felt in the real estate sector?
See, currently the real estate sector was growing at a very fantastic rate, I would say, till Q1 end or Q2 end. It's only in Q3 that suddenly the disbursements have dropped. Companies are busy, HFCs are busy consolidating their back book. Our company has been experiencing a growth rate of about 15% as at 31st December 2018. If I see the growth rate for the 9-month period, at the start of the year we wanted to have a growth rate of about 15%, and as on 30th December we are there. Going ahead, Q4, firstly, we would like to end the year with the similar growth rates. Going ahead, what I see is that the demand is very good as far as Tier 2, Tier 3 cities go. It is only in metros that we see the dip in demand. So 1920 also, what I would say and see is that demand picking up and contribute in Tier 2, Tier 3 cities and contributing more to the growth.
All right, sir, we'll leave it till here. Thank you for talking to Bloomberg Quint.